This is Bloomberg Open Interest. Let's take a quick check on futures right now because they are solidly higher and then some. The S&P 500 up 1.3%, even more so if you take a look at big tech, 2.2% higher before the bell, and even the small caps joining in on the fun. Now coming up, we speak with State Street's Maria Waitman on her call to buy the dip in tech. That's next. This is Bloomberg. All right, we are just moments away from the start of trading. This is Bloomberg Open Interest, and I'm Katie Greifeld. Of course, it's a big day. It's Fed Day in the middle of what is an enormous earnings week. And you take a look at what that means for the pre-market. The S&P 500 up 1.3%, even more so if you take a look at big tech, up about 2.3%. The bells are ringing. We have BlackBerry, we have Armada as well. Of course, ringing those opening bells on NASDAQ, on the NYSE. Take a look at where markets are trading. Just, of course, a few seconds into the trading day. Of course, we have a lot to look forward to, the Fed being one of those just events. But you can see the S&P 500 really rallying right now. The NASDAQ 100, that's going to refresh. You can see 2.3%. The Russell 2000, again, it's not exactly leading, but it's not falling either. The Russell 2000 up about 0.6%. But one stock to keep
as opposed to being up 31% in the quarter before. Returning back to AMD, though, this is something else that investors like, the fact that we do have sequential growth on the top line, 8.9%, certainly better than the first quarter, a little bit lighter than the fourth quarter, but the fourth quarters are typically kind of light, and on a year-over-year basis, big growth. Let's bring it home, though, with Microsoft, Katie, and put Microsoft into the context of Apple, and of course, NVIDIA as a stock. We'll be taking a look later, next hour, in terms of the big rally. But despite that, let's put NVIDIA into the context of Microsoft and Apple. Apple is clearly in white, the world's most valuable company, a market cap of $3.355 trillion. Microsoft falling away, but still in the $3 trillion club. And then take a look at NVIDIA, all the way down there, $2.6 trillion, as that too far, too fast rally is fading, at least right now, although on the day, a bit of a rebound.
Oh, big time. Of course, NVIDIA really surging right now, propping up the whole market as well. Abigail Doolittle, thank you so much. And joining us now for more, I'm pleased to say we have Maria Waitman. She is head of equity research at State Street Global Market. Great to have you back with us. And you had the punchy call actually earlier in the week to buy the dip in tech. We did see Microsoft disappoint, but turns out you probably feel pretty vindicated right now.
Oh, yes, thank you very much, very kind. I mean, our view on tech is that it's still, despite, some slight hesitation in earnings, it's still by far the best earnings there are. I mean, if you look at what consumer companies are telling us, airlines, energy, materials, they all talk about kind of weaker guidance, price inability to increase prices, margin pressure, and tech. Okay, it's growing. I mean, we splitting difference 29-30% or 31. So there is still quite strong earnings growth in technology stocks. So that's really kind of how we see market.
And Maria, if you take a look at the expectations, of course, when it comes to the Federal Reserve, how much is the dot plot going to matter when you think about forward discounted cash flows here? Until now, there has been that expectation for that September rate cut, but how sensitive is the market to the forward look when it comes to the valuations in these names?
Yeah, no, absolutely. That's a really important point. And I guess today's market is not expecting much to happen today, and it's all about guidance for September, for year end, how many cuts we are going to get. And market is very confident that we'll see start of the cutting cycle in September, and that's great for the kind of overall market for kind of every stock. And then we have to kind of debate whether it's this kind of the great rotation in small cap can potentially happen or not. And as I said, our view is that for the rotation into small cap to happen, you need to see broadening of earnings. And given what companies are telling us, where the kind of overall guidance is, it's not broadening. Majority of earnings remain in technology stocks, and that for us means that tech will continue to lead the market.
That's really interesting there, of course, when you think about the overall market, as you call it. It sounds like you're saying that, of course, earnings aren't going to be the catalyst for that broadening out. Do you think that the Fed alone, if we did get maybe more rate cuts than expected, would that be enough to juice small caps, even if earnings continue to be a little bit soggy here?
No, I think I'll be skeptical. I mean, for us, you need to kind of three conditions to happen for the rotation into small cap. One is positioning, and it's very clear that market is very crowded in technology stocks, and arguably that's potentially why we're seeing some weakness. And I mean, interestingly, if we look at investor behavior ahead of corporate earnings, I think for the last 4 or 5 quarters, we've seen the kind of exactly the same picture, is that tech sells into earnings ahead of earnings season, as position is very crowded. And then when technology companies kind of deliver earnings, we see some softness in the rest of the market. Then market goes back to technology stocks, as that's kind of the large cap quality. Quality game it remains important as earnings, as you say, remain overall soggy. So that's kind of the game plan we are following. So a little bit of softness in tech ahead of earnings.
Maria,
wait for results. Hopefully they deliver. And yeah.
You still look at a market here that has more than 3 rate cuts priced in through the end of January. And if you don't see those 3 rate cuts at least materialize, what else starts to break in this market as interest rates stay high, start to break into those companies that are still relying on a lot of leverage at these high interest rates, on consumers that are levered up as well?
Yeah, no, I would definitely agree with that. We're seeing quite a lot of stress for smaller companies, quite a lot of stress for lower income consumer, and that's where the pressure is. And mind you, the rate cuts, exactly the same as we talked about rate hikes, they work with long and variable lag. So even if Fed cuts and delivers those 3 cuts that market is kind of expecting before January, it's still not clear that we'll have the kind of real economic impact and kind of ability to service those debts that are getting more and more expensive for certain groups of the market. So yes, financial markets will get very excited, but in terms of debt servicing costs, we are going to see those kind of stresses for certain parts of the market to continue. So that's, I mean, rate cut is not a silver bullet, really, when we've been at fairly high interest rate for some time.
And I want to talk a little bit more about the concept of broadening out, because we were talking about it really in terms of size, large cap to small cap. But if you stay within the small cap space, I mean, do you see any sectors, industries beyond tech, of course, that are worth venturing into right now?
One place that kind of getting increasingly interesting is healthcare. So that's one sector where investor positioning is particularly light, and the sector still has a decent cash flow. So that's important, and that's important to us. Margin pressure is maybe less challenging. So I think healthcare probably quite an interesting sector. Again, defensive sectors that fits with kind of our overall strategies that economic slowdown is coming.
So what's the trade here, Maria? At the end of the day, do you take money out of certain more profitable bets that you've been making? Do you take money out of cash? Where do you get that dry powder from, and where do you deploy it?
I mean, we've been in this cash plus tech barbell for quite a while. I think that still makes sense to us. Yes, tech has suffered a little bit recently, but as I said, that to us is a buying opportunity, because it still is likely to maintain its leadership as earnings picture is so much better than anywhere else.
Maria, thank you so very much. That is Maria Vaitman of State Street. Now coming up, a new CEO at Boeing. We've been talking about it. They have some headwinds to navigate over there. We're going to have details on that next. Stick with us. This is Bloomberg. This is Bloomberg Open Interest. We're going to take a quick check on stocks. It is a green day today. We are watching the S&P 500 rise to the tune of 1.3%. Even bigger gains in that big tech index. NASDAQ 100 up 2.3%. Russell 2000 getting a bid, but not as much, only up about 0.25%, Katie.
All right, it's time now for our top calls. Some of the analyst action in focus this morning. And first up, TD Cowen downgrading McDonald's to hold and says the shares will be range bound for the foreseeable future. The analyst also saying that the burger giant has a tall hill to climb when it comes to improving its value perceptions versus its peers. Next up, Morgan Stanley renaming NVIDIA as its top U.S. chip stock pick for the first time in 6 months. The analysts over there say that the recent sell-off provides a good entry point, and you can see people taking them up on that view right now. Shares up 9.3%. And finally, we have Bernstein raising its rating on PayPal to outperform. The payments company boosted its forecast for profit and also increased its buyback plan. The analyst sees PayPal having steady beats and raises over the coming quarters. Shonali.
And one stock to watch here at the open, of course, it's Boeing. Shares are higher on the news that Kelly Ortberg will succeed Dave Calhoun as CEO. Bloomberg Intelligence senior analyst George Ferguson is here with more. And George, my major question to you is, when you think about the CEO, the next CEO of Boeing, does Kelly Ortberg fit the bill?
It seems, unfortunately, that we lost George. And I mean, that's the question that basically everyone is asking. I think when you think about what this new CEO has in front of them, both really reaffirming that these planes are safe and also sort of recovering that reputational damage that they took on with all the different incidents, it's a tall order, obviously.
The market likes it so far, if you see the stock reaction here. Of course, it adds a lot of certainty here to the story of Boeing. We're going to go back here to George Ferguson. We have got him back. George, busy week for you over here, and you see the market reacting well. We still do not have George with us, but, we are going to talk more about this story here, because interesting to see a lift here in the stock for Boeing, 1.7% higher. But, of course, this is a stock that has taken a lot of pain this year, especially when you think about the oversupply problem, Katie, in the market.
It's also interesting that Ortberg, he's 64 years old, so he's not exactly new to this company, coming out of retirement to do this. You have to wonder what the plan is. Hopefully we get George back to talk about all of it. This is Bloomberg.
On Bloomberg.
This is Bloomberg Open Interest. Let's take a look at the stock market. About 20 minutes into the trading day, boy, it is green across that screen. You can see the S&P 500 up by more than 1%. Even more so if you take a look at the NASDAQ 100. Your big tech names up 2.2% overall. Small caps, they're doing okay, up about 0.2% on the Russell 2000. But as promised, we are going to talk about Boeing, of course, naming a new CEO. We had been awaiting that. Let's bring in Bloomberg Intelligence senior analyst George Ferguson. George, I hope we really have you because I really want to talk, of course, about Kelly Ortberg. What do we know about him?
So, we know about his career in the industry. He's with suppliers, Collins, helped merge them into RTX. We know he was in retirement as of 2021, coming out to take the job. Engineer, I guess he spent some time at Texas Instruments, but he's been sort of off the radar here for sort of 3 years or so. I was a bit surprised by the call, but I don't know. To me, it feels a little bit like a caretaker CEO again, right? So we have somebody, I think, that's about 64 years old. Can't imagine they've got a long runway for Boeing. I think it's indicative of some of the challenges of finding a CEO for this company that's in really some difficult straits right now.
George, can you speak a little bit to the challenges that will lie ahead for Kelly Ortberg?
Yeah, I mean, when I look at his experience, right, it's with smaller component manufacturers. If you think about Boeing is a big systems integrator, right? You bring in your parts from all around the globe and you turn them into airplanes in the factory. And so to me, that feels a little bit like a different skill set. And that's been the challenge here at Boeing, is sort of bringing all those components in and turning them into airplanes with top-notch quality. So I think that obviously that's number one, is stabilizing the manufacturing. But we saw Boeing during the quarter, they burned another $4.3 billion of cash after CapEx. So they now have about $13 billion on the balance sheet. They're starting to get dangerously low. They may have to come to the capital markets to raise money if they keep burning cash like this. And so what they really need is a ramp up of builds for the commercial product in the second half. It needs to be strong. It needs to be soon, or they'll be back in capital markets. And so we're looking for Kelly really to get motivated on that. And then on the way to doing that, he's going to start by talking to the machinists union that wants a pay increase. Their contract expires in September. They want a 40% pay increase. So he's going to go right into the deep end immediately.
Yeah, absolutely. You think about the labor challenges there as well. But it's a good reminder that we did see Boeing actually report earnings today, second quarter, missing estimates on revenue. We also heard from its main competitor, Airbus, earlier in the week. And a lot of analysts called out the positive surprises for Airbus. I mean, when it comes to this real duopoly between Airbus and Boeing, how does the competitive landscape stack up between the two right now?
Yeah, look, they're both struggling right now with supply chain. Boeing's struggling a lot more, but Airbus is just not getting the throughput they want. They've had to push back some of their larger increases in production out to to 2027. They like to give us long horizons on build rate. They talked about problems that, with LEAP engine deliveries, which come out of GE and Safran, which I thought was doing a relatively good job of getting their engines built compared to their competitor RTX Pratt & Whitney. So look, the duopoly is, when one thing affects one of the duopoly, you can usually count on it affecting both. And so nobody's really getting, I think, a firm sort of leg up here because of these supply chain challenges. But Airbus is operating, I think, a lot smoother than Boeing is right now.
George, really curious here. I also just want to nod to this kind of $500 million cost that Delta has also said this morning that they would be incurring tied to the CrowdStrike outage.
Yes.
What does that number strike you as?
It's large. $500 million is large. I think Delta, look, they're hiring attorneys to go out after CrowdStrike, so you'd expect the number to be big, when they bring it into the marketplace. I'm sure Ed Bastian very upset because Delta had generally done a pretty good job of operations, but if you look at the industry, we see operational problems around it over time. American had this spate of problems. Then we saw Southwest have this spate of problems. Now they've landed on Delta because CrowdStrike was probably too embedded in some of their, some of their systems. It's challenging to always be proofing your supply chains, making sure there's no chinks in the armor. In this one, he had one. I think again, Ed Bastian, very disappointed. I think took a bit of a beating with his customers over this, and coming out with with a big number to show he's very upset.
George Ferguson, we thank you so very much for your time. That is Bloomberg Intelligence's airline analyst. Now it's time for the Wall Street Beat. We're talking about Ares today, setting a new record by raising over $34 billion for its latest direct lending fund. Of course, that number includes leverage. Joining us now is Bloomberg private equity reporter Allison McNeely. That $34 billion number that they've compiled, we're talking about the capital base that they're putting together for new deals in lower middle market, upper middle market. How does this number compare to what's been going on out there right now?
Well, it's really a continuation of a theme we've seen in the race into private credit. It's a new record. Ares raised about $15 billion worth of equity commitments. When you add leverage and separately managed accounts, that gets you to that record $34 billion figure. By comparison, Goldman Sachs gathered about $20 billion a couple months ago. And so we're seeing, players raise ever larger funds as they look to essentially step in for the banks, which have pulled back from middle market lending, and make some money doing it.
So $34 billion, that's a lot of money. Are there enough deployment opportunities? Are there any concerns about that?
That's a really good question. So Ares' first quarter results actually came in a little bit light a couple of months ago because of more muted M&A activity. Therefore, there were fewer deployment opportunities, fewer opportunities to lend. So that's a really big question that's kind of looming over all of private credit right now, but particularly sort of direct lending middle market loans. Are we going to see that pick up in deal-making activity that presents opportunities to lend money?
Allison, I would love to also talk about KKR results here for a minute while we're sticking on private markets, because you are having KKR shares hit a record high right now. Profit is improving. What are they showing and putting up on the board here?
So KKR has been talking a lot over the past couple of months about the improving picture for regular way private equity deal making. They reported a soaring profit in the second quarter, for up 49% on a key metric, because they sold more assets than people largely expected them to. AppLovin share sale was one deal. A sale of their stake in the ADNOC pipeline network was another. And they say there's more of that to come. And the deal-making environment for private equity is improving.
All right, Allison McNeely, great scoop. Really appreciate you sharing some of your reporting with us. And we do have to get to some breaking news right now. Uber and Lyft, the NYC taxi regulator, agrees to not impose those new rules on both of those rideshare companies. You can see stocks rising right now in response. Uber up 2%, Lyft up 1.8%, now 2%. Let me just read that headline one more time, that the NYC taxi regulator agrees not to impose those new rules on Uber and Lyft. You can see the relief rally right now. We'll continue to follow that story, of course, and markets on this very, very busy day, because coming up in the next hour, we have former Federal Reserve economist Claudia Sahm. We'll speak to her about what she's expecting and why she thinks that the Fed should cut interest rates. That's next. This is Bloomberg. All right, we are 30 minutes into the trading day on this Fed day. Welcome to Bloomberg Open Interest. I'm Katie Greifeld.
And I'm Sonali Basak. Matt Miller is off today. And coming up, countdown to the Fed. Officials are expected to hold rates today while signaling a potential cut in September. And tech stocks are rebounding despite disappointing earnings from Microsoft. Up next, Meta and Qualcomm report. And geopolitical risks are rising as Israel's twin strikes in Tehran and Beirut ratchet up tensions.
All right, let's get a check on these markets. About 30 minutes into the trading day, you can see we have a rally on our hands. We have the S&P 500 up about 1.3%. Of course, we have big moves in NVIDIA that's helping the S&P 500. It's also helping the NASDAQ 100. Your big tech index up 2.4%. Of course, we are in the thick of tech earnings. Some big ones coming after the bell today, so keep an eye on that one. Also, the bond market, the 10-year yield. We have a rally underway, down 4 basis points. We are getting closer to 4%. Of course, it'll be fascinating to see what happens at 2 p.m., Sonali.
And we are getting ready for that Fed rate decision, of course, out at 2 p.m. this afternoon. Michael McKee, Bloomberg's chief international economics and policy correspondent, joins us now from Washington. Mike, what are you expecting?
Well, we're not expecting the Fed to move, but we've certainly gotten data today that for the most part pushes the Fed in that direction. We just got pending home sales for the month of June, and it's the largest rise in pending home sales, 4.8%, since the month of December last year. But the other data coming in today, employment cost index comes in cooler than anticipated and down from last quarter, 0.9%. Wages and salaries up just 4.2%. That's what the Fed wants to see. ADP, to the extent you trust it, is 122,000 jobs created in July, and that is the weakest in some time. Also January. I would point out that non-farm payrolls, the private payrolls number, is expected to create only 141,000 jobs this time. That's what your comparison with ADP would be. So we are looking for a little bit weaker job growth. If unemployment goes up, though, that might trigger the SOM rule. There are 3 things to look for here today because we only get the statement, don't get a dot plot, don't get an SEP. The characterization of the economy as strong and unemployment remaining low. Are they starting to realize unemployment's going up? Inflation, they say, has eased and there has been modest further progress. Do they say there's been significant further progress? That would be a hint to September. And then the forward guidance is going to be the most important thing, this idea that they will not reduce the target range until they've gained greater confidence inflation's moving to target. That would have to change if they're going to suggest a September rate cut. The Fed would be following the Bank of Japan in moving rates. Bank of Japan raised interest rates for the first time in years, just to a 0.25 percentage point, but that has had a major impact on dollar yen. Yen has strengthened significantly over the last day, and we would anticipate that would continue if the Fed gives a strong signal today. So look to the yen at 2 p.m. when we get that Fed decision.
Yeah, absolutely. And the yen right now, 2% stronger against the dollar. Mike McKee in Washington. We'll let you get ready for the big dance. But Mike brought up the SOM rule, and I'm pleased to say that we're joined now by Claudia Sahm. She is a former Fed economist who's now chief economist over at New Century Advisors. Of course, she developed the SOM rule for dating the beginning of recessions. And Claudia, when you look at your rule, what does it tell you about what the Fed should do today?
There are clear risks. There is cooling, maybe in some pockets weakening in the labor market. We do still have a strong labor market, by and large. For the Fed in particular, they need to recognize that the risk around inflation and around employment are now balanced. The chances of the higher unemployment are balanced on par with the chances of higher inflation. That's another piece of the statement that I'll be watching, because you just want them to be attuned to that, the risk factors.
What does this mean, Claudia, about the pace of decreases that you might see from the Fed? People will be equally looking out for the dot plot. There are many prominent economists that are saying the Fed is very dangerously close to triggering the SOM rule and getting into that recession zone.
The Federal Reserve should be responding to the fact that inflation has begun its normalization. It's far on the path to 2%, and that's their job. That's the problem right now. Inflation is too high. We are getting there. The Fed needs to start stepping aside gradually and begin cutting rates. By waiting, particularly saying, well, there's no urgency right now to cut. The sombra hasn't triggered. The unemployment rate is still low. We're still got growth. Okay, that is all true. Monetary policy that is done because it is urgent is badly done monetary policy. When we get to a recession, the Fed's tools, big interest rate cuts, which would be disruptive, they take time to work through to the real economy. Like the recession, to some extent, the damage is done if the Fed waits until it gets really bad. Just start cutting rates, and there's no reason to wait. They have a very strong, credible case on the inflation data, the inflation outlook, to say it's time.
Right.
Just gradually.
Well, Claudia, to that point that they should be proactive, not reactive, and they should begin cutting rates, should they start today, and will they, in your view?
Today is a real missed opportunity for the Fed. They have a very credible case. They have an opportunity to really shift us from hyper data point dependence to, hey, here's some data. Look, rents are easing. Here's the outlook. Look at consumer behavior. Look at the beige. But like they could really open it up today and get us off of this looking at the last little CPI prints. So just like that's everything hangs on. They're not going to do that today. They have put this all on, we need to be confident, more confident. Right? This is not about basis points. This is about some psychological baggage of monetary policy at the Fed, right? Like this, they've made this into a very big shift. And honestly, that's not the way to approach this very disrupted economy. It is so much better to begin a gradual process of figuring out what's normal on the other side of this for the interest rates. And by waiting and waiting, the risks are bigger that this unwinds very disruptively, and today they are still in the place of doing communication policy instead of rate policy, and we could see that cause some real problems this afternoon because communication is tough between the Fed and the markets.
Well, Claudia, so it's July 31st. After this, of course, the September meeting is September 18th. If they wait until September 18th to cut rates, that month and a half or so, do you think that we'll see the risks then? Is that enough time to potentially see some trouble there? Or do you think that, a month and a half isn't going to make that much of a difference?
We've seen the economy on a cooling trajectory, right? We're still in a place of strength. A lot of this cooling has been necessary, right? We're normal. We're getting out of this very disrupted 4 years post-pandemic. What we haven't seen up to this point is something to level us out, kind of go into the growth path. The Fed has a tool by taking some pressure off with interest rates. They are a lever that could help level things out. So what is it that levels us out and puts us on the growth path if the Fed has tied its hands and is waiting? That's a good question. So I think the risks do build. Does that mean in September we'll look back and know for sure, it was a mistake not to cut in July? Probably not. But will we look back 6 months from now, 9 months from now, and say that was the missed opportunity? That's what I'm much more concerned about.
When you look at the signs of weakness that are starting to show up in the economy, Claudia, I want to recognize that this week is a very challenging week for economists, for the Fed, and for traders, given that you not only have the Fed today, you have jobs report on Friday as well. When you think about the direction of the labor market going forward, how much of a risk is there that things start to drop off more meaningfully?
We are not standing on the edge of the cliff. Right, so there's a lot of discussion about the recession indicators like the SOM that potentially, if the unemployment rate ticks up again, would trigger. Normally in the past, that has been, basically in the past 4 decades and decades, would have been consistent with early in a recession. Do I think on Friday that we are early in a recession if it ticks up? No. I think there are just a lot of reasons for economists. You said it's a challenging time. Just trying to measure what's going on is really tough. Our indicators in the past, they're probably overdoing some of these signals for lots of different reasons. And yet, the fact that the unemployment rate has drifted up as much as it has is a real concern because there is a dynamic in the economy. Once things start going south, if they pick up enough momentum, that's where they keep going. And then we're not like 100 basis points on the federal funds rate. It doesn't stop that, right? Like this is, so it's something to take very, very seriously.
And Claudia, we have about a minute or so left with you. I have to ask you about politics because you look into next year, of course. If we do get Trump 2.0, there's a lot of concern that what we could get on tariff policy, on tax policy, that it could spur a tick up in inflation, if you want to call it that. I mean, how are you thinking about that when you think about the future of Fed policy and them trying to basically make policy in that environment?
Right. Fed policy is never going to get easier, right? Every step on the road, there's going to be something new that they will have to deal with. I think it's important to really focus on it, and I have heard Jay Powell say this, focus on what is ahead of them, right in front of them, and deal with that, right? Don't complicate it by thinking about, well, what is it next year and with tariff policy. The Fed has had this discussion of, oh, we don't want to cut rates too soon and then have to raise them. It'd be such a big policy mistake. Look, monetary policy has to evolve to a changing world. Like, if you would have a fundamental change in macroeconomic policy that affects inflation, the Fed will have to adapt to it, right? And they shouldn't be trying to front run it, and they shouldn't be denying the current reality to worry about all of these, possible cases in the future. So it's something for them to be aware of. It is not something that should be featuring heavily in, do we reduce interest rates here in July or in September or whenever.
Claudia, we have to leave it there. That is, of course, Claudia Sahm of New Century Advisors and the woman, of course, behind the very highly watched Sahm Rule. And our special coverage of the Fed decision begins today at 1:30 p.m. Eastern. Do not miss it. Now let's get a look at the stocks moving this hour. A lot of earnings under the surface. Here's Abigail Doolittle. Abby.
Lots of earnings indeed, Chanelli. Let's start off with the shares of Boeing. They're up about 1% at this point. Now, it's interesting because, of course, they missed the second quarter revenue estimate slightly. They also posted a loss of $1.4 billion, a little greater than that. But the news of a new CEO, Kelly Ortberg, taking over for Dave Calhoun, well, investors seem to be looking at the results and looking forward to the future and the idea that maybe things can turn around for this beleaguered airplane maker. Let's take a look at the shares of Humana all over the map. Earlier today, up significantly, I think up 8%, now down sharply, down 6.3%. They put up a huge beat, 19% adjusted earnings beat. They also beat sales by 3.7%. But what folks don't like is color from the earnings call, the management talking about the idea that hospital admissions could be higher and that patients may be staying longer in hospitals. That, of course, will mean that they will have a greater cost. And then finally, rounding out the picture, Starbucks, it's less bad than feared. The stock is up 3.5%. Katie, as you know, they basically put up an inline quarter, but the fact that into this quarterly report, the stock down 20% year to date, lots of concerns about growth in various geography and too many stores. Well, the fact that they just made the numbers has the stock up about 3.5%.
Yeah, a little bit of a relief rally underway in Starbucks. Abigail Doolittle, thank you so much. Now, coming up, Donald Trump's lead in swing states has evaporated since Kamala Harris entered the presidential race. More on the new Bloomberg Morning Consult poll next. This is Bloomberg.
Fed decides.
Who said summers were quiet? I don't remember the last quiet summer.
We're talking about the data not being as accurate during this time of year, an election that's haywire.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
Is the answer here, Jeff, that everything is just plain solid?
It's pretty solid, Tom.
At some point, we got to call it a soft landing.
Tune in to Bloomberg Surveillance, The Fed Decides, starting at 1:30 p.m. Eastern.
And now to high interest, a look at what's making headlines around the world. Inflation in Europe unexpectedly quickened, with consumer prices rising 2.6% in July year on year, and that's up from 2.5% in the previous month. The report may make the ECB warier about cutting interest rates further in September after an initial cut to the rate in June. And Israel said it assassinated top leaders of Hezbollah in Beirut and Hamas in Tehran, a show of the country's willingness to risk retaliation and an escalation of regional tensions while hunting down enemies abroad. Iran's supreme leader spoke of retaliation, vowing that Israel has prepared the ground for its severe punishment. And over in the United States, the race for the White House, the presumptive Democratic nominee Kamala Harris has wiped out Republican nominee Donald Trump's swing state lead, according to the latest Bloomberg Morning Consult poll. The vice president overtook the former president in Arizona and Nevada, and she has more than doubled Biden's lead in Michigan. Katie.
And for more on the latest in both domestic and global politics, I'm pleased to say we're joined now by Bloomberg's Wendy Benjaminson in Washington. She spearheaded the Bloomberg News Morning Consult poll. And here with us in studio in New York is Bloomberg's senior editor, Bobby Ghosh. And Wendy, I'll start with you because this poll definitely surprising here. This momentum behind Harris really showing up in the numbers, but still, it's a dead heat right now.
It is a dead heat, and it's, right now the momentum is all in her favor. It sort of wiped out the momentum that Donald Trump was feeling, partly while the Democratic Party was in this internal battle about whether Biden should continue the campaign, and then the sort of glorious moment he had after he survived the assassination attempt with that famous photo, and it all looked like it was going his way, and then Kamala Harris steps in, and the momentum has just shifted entirely, particularly with the voters that Biden was losing tremendously, black voters, Hispanic voters, and young voters. All of those people told us in our poll that they were much more motivated to vote in November now that Kamala Harris is at the top of the Democratic ticket.
Wendy, how do you think about the pivot points between now to the Democratic National Convention? You think about the money raised over the last week by Kamala Harris. You think about the polls as we were discussing. You think about the upcoming fundraisers for Donald Trump. We just had Howard Lutnick say that he's trying to raise $10 million this weekend alone. So what comes next for the two of them?
Well, it's really game on now. I mean, we really have a campaign that, that everyone has been sort of waiting to have happen, and we only have, I think, 98 or 97 days left. So, yes, Howard Lutnick out in the Hamptons this weekend is holding a fundraiser for Donald Trump. We reported yesterday that Ken Griffin was raising a lot of money for Donald Trump, and yet on the other side, you have, that biggest Zoom call ever with women raising money for Kamala Harris. She raised $200 million in a week. That is unprecedented, especially with 66% of those donors being first-time contributors to a political campaign, which suggests a grassroots support, which counters the billionaire support that Donald Trump is getting.
And of course, this conversation is happening against the backdrop of increasingly fraught geopolitical tensions. And Bobby, I'll turn to you on this because we saw twin strikes from Israel overnight, of course, retaliating against that attack last weekend that killed about a dozen young people. It seems like this retaliation, though, was a bit more extreme than had been expected.
Well, the taking out of a Hamas political leader in Tehran, I don't think is connected to last week's events. Hania has been a target for Israel for a very long time. Israel has said unambiguously that all senior leaders of Hamas are legitimate targets, whether they represent the political side or the military side of that organization. It was a matter of opportunity, and it's quite striking that they should have found this opportunity and taken it in Tehran. I mean, Hania had gone to attend the swearing in of the new president of Iran. A huge embarrassment for Tehran, a huge intelligence failure on their part. But it throws the whole region into even greater turmoil than it was, 10 hours ago, 15 hours ago.
So, big picture, what does this mean for the escalation of the conflict, and what do you look for next?
Well, so we are now deep into the unknowns in this region. I've been covering this region for 25 years. I've never seen a situation like this. All the traditional rules of engagement, unwritten rules of engagement that govern Israel and Hezbollah, Israel and Iran, those are all have been out the window for some time now. The last time Israel mounted a major strike against an Iranian target was in Syria. This was in April. Iran responded by doing something it had never done before, which is fired off missiles and drones directly at Israel. 300 of them. That was a big, big event, and a big Rubicon was crossed that day. So the risk of escalation now from that point is even greater. So everything, it's a horrible cliche, but it's absolutely true. Everything is on a hair trigger's edge. In the middle of all this, there is Gaza. And hopes for any kind of ceasefire there now are certainly, if not dashed permanently, then they're certainly pushed way out. Because this man who was killed was crucial in those negotiations for a ceasefire, which means more and more Gazans are going to suffer death and destruction and suffering that we've seen. It also means possibly that the Israeli hostages that remain in Hamas's hands are going to face an extended period of remaining hostages. So this is very, very destabilizing, even though it might be that Israel feels it has achieved a strategic objective.
Well, of course, this is all happening with what is a lame duck president in the U.S. And Wendy, I'll come back to you on this. When you think about the two different campaigns right now, we're focused a lot on the politics, on the fundraising. But when it comes to the actual policies, specifically geopolitical policies and how to deal with Israel, I mean, what are we hearing from the Harris camp? What are we hearing from the Trump camp?
Well, this is a tricky position for Kamala Harris right now because Joe Biden is still president of the United States. Kamala Harris is his vice president. And so while she may say things to Netanyahu as she did last week in private, in public, she must show a united front with the president. We believe that the United States' position on this is going to be to defend Israel against attacks, but they are discomfited, to say the least, with the notion of the ceasefire talks continuing. We had Defense Secretary Lloyd Austin telling reporters in Manila that they were really going to work to keep this from becoming a wider-ranging conflict. Indications are, although remember she's only been the nominee for a week and a half, indications are that Harris, at least reading the political tea leaves, will move slightly away from the full bear hug of Netanyahu that the Biden administration has continued to give. But it will be a matter of degrees, we believe. But she hasn't said anything about these events publicly yet.
All right, Bloomberg's Wendy Benjaminson in D.C. and Bobby Ghosh on set with us in New York. Thank you. This is Bloomberg. All right, let's get a check on these markets because they are flying right now. The S&P 500 extending gains up 1.5%. The Nasdaq 100 even more so, up 2.6%. That comes back to NVIDIA. Shares absolutely soaring right now, up nearly 20%. You can see that really giving a lift to the broader market as well, Shonali.
And coming up, as competition in the soda space bubbles up, we're going to speak with Ben Goodwin. He's the CEO of Olipop. Stick with us. That conversation is next. This is Bloomberg.
Like Bloomberg.
We're putting the spotlight today on the soda wars as competition bubbles up across the industry. We're going to get to Bloomberg's Abigail Doolittle for a closer look.
Well, when we think of soda, Shonali, of course, we think of Coca-Cola and Pepsi, and it's a tale of two stories, really, relative to the recent quarters. Coca-Cola put up a decent quarter, a good quarter, beating second quarter earnings. They also raised their full year outlook, and I believe there was some nice pricing power there. Pepsi, on the other hand, their sales did disappoint. This as U.S. consumers seem to cut back on that particular brand. And then there's, of course, Olipop, the private company. They've had the good fortune recently of raising over $40 million in investment capital, and they are in more than 30 retail locations, including Walmart. Just looking through some of the notes here, very exciting. But when we bring it back to some of the publicly traded companies, it really illustrates the idea of what you were talking about, the soda wars. This is a year-to-date chart. In white or in red, we're looking at the S&P 500 as the benchmark. Then in white, Coca-Cola, the company that outperformed. In orange, the overall soda, food, beverage, tobacco index. And then in blue, to PepsiCo, they, of course, again, their sales disappointed. So this really points again to that idea of the soda wars that we're seeing right now, Katie.
All right, Abigail Doolittle, great setup. Appreciate that. Let's get more now on this highly competitive space with Ben Goodwin. He is the CEO of Olipop. It's a beverage company, of course, set to hit about $500 million in sales this year. And as we heard from Abigail, you're in dozens of retail locations at this point. And I'm curious who you're taking shelf space from. Are you taking it from big soda or another category?
Yeah, so we're in about 35,000 retail doors now nationally, and it's definitely been a rocket ship for us. We've grown triple digits every year. In fact, one year we nearly grew quadruple digits. So that's been exciting to manage. There's a lot of pulling consumers into the functional category, which is obviously typically a trade up in price. And I'd say somewhere in the 60 percentage points, it's kind of that incremental purchasing. But then in the kind of mid 30 percentage points, we are actually seeing a lot of pulling from other categories. Some of that is things you might expect that are already somewhat in the health sector, like a sparkling water or maybe a kombucha or another functional beverage. But we are also pulling share from traditional soda, and it's kind of all the three big players you would expect.
Or also, traditional wine drinkers. If you think about it, you're buying a 12-pack really of Olipop for almost $36. You have a premium price point here. How far does that go at the end of the day? Does that work for you?
It really can. Red Bull is a $10 billion plus business that has been consistently charging north of $249 since its inception 40 years ago. They just grew 10% last year. They're making a great run for it. I think at the end of the day, the higher price point has to be correlative with the perception of value. And consumers are actually seeing that value because with Olipop, they're able to have the traditional soda experience that they love and has a lot of nostalgia for them, but they're trading out the high sugar. We have 2 to 5 grams instead of 40 for a typical soda. And then they're also getting the added benefit of research-backed fiber and prebiotics. So that really, right now, they're seeing that equation is worth it for them.
Let's talk about demographics here, because you think about Gen Z, for example, we know that they're drinking less alcohol, for example. It seems like they are gravitating more towards these healthier alternatives. Does that help explain your growth? What does your demographic breakdown actually look like?
No, absolutely. I would say that, soda is a Big 10 category. So that means that we track against all generations, and, we certainly do well with older generations and millennials. We also over-index with Gen Z. And it's actually, and even Gen Alpha. And one of the things that's really satisfying about that and rewarding is traditional big soda, if you will, has seen about a 60% collapse in that younger demographic over the last 10 to 15 years. But our philosophy and our theory has always been Americans still love soda. They've just fallen out of love with the ingredients and are looking for something better. So we see an over-indexing with that younger generation, and it's perfect because we're basically setting this category in Olipop up to kind of be the third wave of soda. Traditional soda going all the way back to the 1980s, diet soda in the 1980s, and now functional soda led by Olipop. And this new generation is really the one spearheading that into the future.
Ben, we've reported, of course, that you are on track to hit $500 million in sales this year. You're now profitable. What is your end game? Do you want to be owned by one of these larger beverage companies, a Coke or a Pepsi? Or do you plan to go it alone? Do you think an IPO is in your path?
Right now we're actually keeping all those options on the table. The triple-digit growth and the profitable operating that I mentioned earlier has kept us actually quite busy. The other nice thing about that is it actually generates a lot of options. But for us right now, our focus is full hands on deck. Let's keep seeing how big this thing can get. Still have a lot of brand to build and a lot of channels to go after. So that's the focus right now. I can say that wherever Olipop ends up, it will always be in a place that we think can maximize the outcome for the business, but can also really continue to help us pursue the mission. We want to make sure that this is a product that's available and a brand that's available at a really high level of quality for decades to come.
All right, so we'll keep in touch with you on that one, but appreciate the clarification. You're focused on the mission right now. I actually want to go back to the price point because, like Shonali mentioned, of course, $35, I think, for a 12-pack. Or
you could buy a bottle of wine.
There you go. And, I mean, you think about the consumer right now. I mean, we talk about it on this show all the time, that pinched consumer. And this is a premium product. Do you have a plan to bring prices down, or how are you thinking about your pricing strategy right now?
Yeah, I mean, certainly that's something we could look at for the future. Transparently, that's not something we're considering right now. You can purchase the full $35 12-pack off the website, but that is actually, honestly, probably the most expensive way to interact with the product. Many of our consumers are going into the stores and buying a couple of cans at a time, which helps to kind of manage the actual price structure. And actually, we're also launching multi-packs into stores at a accelerated rate right now, where there's also a slightly better pricing structure at a per can basis. And then there's a variety of different ways to find the product intermittently on promotion as well for people who want to try the product and figure out whether it's worth it for them to buy more regularly. But one of the other things that we have going for us is we've actually put a lot of research behind the product. We've got a great partnership with Purdue. We've done studies with them on the efficacy of the product, stability of the product, things of that nature. And that's opened up some really interesting doors for us in the world of insurance reimbursement. So right now, we partner with a number of different insurance reimbursement networks, and somewhere in the realm of 40 million Americans can actually get Olipop reimbursed against their insurance benefits. So for a customer who's motivated to try the product, they may actually want to check and see if their insurance offerings cover Olipop, and that's a format for us not only to make sure we're getting the product to people who really need it, but we're also working our best to increase accessibility.
Ben, we only have about a minute left here, but you were talking about the third wave of beverages here, healthier beverages. What is next for Olipop? What are you coming out with? Where are you going to find Olipop next?
So we've got really exciting partnerships coming up. We're basically, for us, we're trying to move into a lot of the different spaces where you will have traditionally seen big soda operate. And that's kind of the next step up in our evolution as a brand. There's new flavors coming. There's some more very, very cool IP relationships similar to what we did with our Barbie collaboration into the future. And there's a lot of pretty significant accounts coming on board that's going to even increase our accessibility even more. So more Olipop, more flavors. We're looking really, really forward to being available for more Americans all over the country.
Ben, we thank you so much. That is Olipop CEO Ben Goodwin. Now we're going to get a check on the markets here with Bloomberg's Abigail Doolittle. Abby.
Well, it's hard to believe, Shonali, but we are, of course, at the end of July. So let's take a look at the NASDAQ 100 on the month. Now, the S&P 500 on today's rally has turned into the green on the month, but not so much for big tech because it's been a bit rough month for big tech. The NASDAQ 100 right now down 2.4% in the month of July. As for some of the big movers beneath the surface, and these are for the S&P 500, just so that we can take a look at some of the percentage gainers, clearly not big tech. Mohawk Industries, the flooring company, up 43%. From a percentage standpoint, this is the best company in the S&P 500 in the month of July. They put up a better quarter and guide. Stanley Black & Decker up 33%. It's interesting to see both of these in sort of the related area of construction, fixing up, that sort of thing. They also put up a better than expected quarter and the better guide as well there. As to the downside, Micron down 16.2% in the month of July. Not so great at all. They beat. They guided higher than the expectation, but it wasn't enough given the fact that into that quarter, the stock had been up 80%. And then NVIDIA is super interesting. On the day, up about 10%. On the month, down 7%. Yesterday, closing at 103 thereabouts. We've been talking about how if below 118, it could go sub 100. The question is 103 sub 100 or not? We're taking a look now at the monthly chart. We were looking at the daily chart earlier when talking about sub 100, and it could still go there. Take a look at this uptrend for NVIDIA. These are monthly candles. You cannot see the gap. There's a gap around $90 or so on one of the big beat and boost quarters earlier this year. Those gaps tend to fill. When we take a look at these candles, it does look like we are going to see NVIDIA go back down toward that uptrend. This is the same uptrend right around 90, thereabouts. And then you can see the monthly RSI, that movement, it is heading down. That signals momentum coming out. And then finally, Katie, take a look at the yellow line. That's the 200-month moving average. That is at $9.60. That is how extended this stock is right now at 115. At some point, when they don't put up a perfect quarter and a perfect guide, it could be pretty painful. Whether or not that comes in August, we don't know. But this chart still suggests that there could be some serious consolidation ahead. It may not be immediately, though.
Yeah, I was just looking at it. NVIDIA doesn't report until August 28th, so unfortunately we have quite a while to wait there. Bloomberg's Abigail Doolittle, thank you so much. Now coming up, a string of security deals have deepened U.S.-Japan military links. Up next, we'll hear from Washington's top envoy to Japan, Rahm Emanuel. That's next. This is Bloomberg. U.S. Ambassador to Japan, Rahm Emanuel, says that China is cheating its way to leadership. He spoke to Wall Street Week host David Weston at the Aspen Economic Strategy Group's annual meeting.
A lot of times we think China's on the ascent. They got the fact is, in the last 3 years, and I don't mean to just dub this but during President Biden's tenure, when you look at where we were 3 years ago, China has gone from on top of their tippy toes to back on their heels. You look at, just take the political side, building this lattice-like work on the strategic side as well on the diplomatic side with Korea and Japan and the United States and the Philippines, what we're doing with AUKUS, with UK, Australia, the United States. China's has, their whole script is to isolate country Philippines, isolate country Japan. The script's been flipped, and the isolated party is China. And they are now on their back heel. They're also economically, I don't mean to say this, but if I could, I just hope the PRC leadership stays on their strategy economically. It's working unbelievably well for us, because they have an incredible problem now when you look at everything that's going on in the country domestically. You look at their cities, municipalities, you look at their belt and roads, all of it is running a massive economic problem for them, and and it's a deterrent. And they know anything they do strategically has an impact. The thing that we haven't done, this is true in conflict with China and Russia, they operate, you can see like Russia, they're doing it in Europe, these kind of what's called gray zone. It's not kinetic, but it's just enough to throw you off. China's doing that. We kind of have a black and white, and we don't operate there in that kind of gray area that throws the opposition off. But China right now is the odd man out in the Indo-Pacific. You can look at it on any level, and a lot of what has been put together in the last 3 years has made China the isolated party, not allow China to isolate country A.
Do you see a path forward to a world in which we engage with China economically? We don't just isolate them. That's unrealistic given their size. But do not enable them. Because it feels like the United States has gone back and forth.
Nobody would ever look at this and say, this is a diplomat. So where deterrence ends and provocation begins, I don't know. And nobody knows. It's more art than it is science. You can have engagement. So here's just a short, I thought it was the right strategy when you look at equities, where China was, better to have them in the tent than out. What the mistake was in 2012, basically when President Xi comes to power, they went from thinking of America and the West as strategic competitors to strategic adversaries. We held on to strategic competitors a decade too long. Now we're accelerating, realizing this is different. You can't have a system where somebody's part of it, where intellectual property theft is a norm. It's just too volatile to a system based on trust and law. Look, Google, they're stealing stuff from Google. That's now a case. They're stealing stuff from ASML, and I'll take one case. ASML makes the semiconductor laser technology. Tokyo Electron is a big competitor. Nikon's a big competitor. They compete. They out-innovate. They don't steal from each other. But China is stealing, and they've been caught stealing. You can't have an international system. So can we have? Sure, you can trade, but you can't steal. You can't cheat. Okay, and you can't subsidize your private sector to the point that the whole strategy is to crush the opposition. That's a different economic model to the point that it's destructive. You can have your own economic model of socialism, if that's what the country wants to do, but stealing, cheating your way to leadership, you can't have a system that in the end of the day is law and trust. And so I don't know, you're not going to cut them off and have two parallel systems. But if there's going to be integration, there has to be an acceptable norm.
But you talk about deterrence.
Yes.
By definition, that's getting someone to change their behavior. Has the United States...
It's interesting.
Have we ever changed China's behavior in any regard?
Yes.
With the WTO, we thought that would change the behavior. Did it really?
No, what we thought was that they would be vested interests. I'm not sure change behavior. I think deterrence is to make somebody think twice. What is the... Look, in politics, you're sitting in a room, whether I was mayor or chief of staff to the president, you're weighing the equities. If it's 100 and 0, you don't need judgment. It's when it's 51 to 49 that you need judgment. And deterrence is making people evaluate the equities versus the losses and think twice before they do something that becomes provocative or upsets. And so that's how I think of deterrence. And I think, I do think China's domestic economics is a deterrent. And they have made more decisions that have been more of a deterrent to them economically than kind of our own impact of some of the things that we've done. We've added onto that. But I think the mistakes China has made have had real consequences at home.
And that was U.S. Ambassador to Japan, Rahm Emanuel, speaking with Wall Street Week host David Weston. This is Bloomberg.
Shares of Meta rising today ahead of earnings. Mark Zuckerberg will justify heavy AI investments that he considers fundamental. Now, will investors think so too? Bloomberg Intelligence senior analyst Mandeep Singh is here to discuss. Of course, we know that in this earnings cycle, more investors have been more discerning about that CapEx spend behind AI. Meta still on the rise today, despite what you saw from Microsoft. What do you expect?
Well, so the key is what are they going to do in terms of their CapEx guide? I think everyone expects it to go up, but also what they say around monetization, because Meta is one of the three companies that has its own large language model, and they have open sourced it. Now, in the case of Microsoft, everyone knows that they are able to monetize AI through the cloud infrastructure. They called, a $5 billion run rate business that didn't exist last year. And also the co-pilots. In the case of Meta, we don't know how they're going to monetize. It will show up in the ad pricing and sales, but beyond that, we don't know how they'll monetize.
And you think about where the stock sits right now. I mean, the year of efficiency really delivered in terms of performance. And I mean, it's just interesting that we're talking about CapEx and investors are so focused on CapEx. And that's after they really rewarded that discipline in the past.
Yeah, and in the case of Meta, it's the CapEx that goes to Reality Labs and then the AI side of it. So AI CapEx is perceived as a good CapEx, Reality Labs not so much. Although, to give them full credit, they have seen some traction with their Ray-Ban AR glasses. I just don't see a path to monetizing it in the same way they do it on the ad side.
Based on what we've seen so far out of this season, what do you expect in terms of advertising here? How does the market even look when you think about Meta's place in it?
So to me, the key is Amazon here. And I know a lot of people will be surprised because Amazon's ad business is the fastest growing ads business. You know, they're a $50 billion run rate, grew 25%. Meta was similar last quarter, but the fact that Pinterest guided lower, it tells me that Amazon is having a real impact on the digital ad side, and it will be interesting to see if Meta says something along those lines.
And of course, you cover it all. So I'm actually going to ask you about Uber right now. Uber obviously in the news today, both for what's going on in NYC, but also earlier this morning, the headline that Uber is partnering with BYD for 100,000 EVs. I mean, what did you make of that?
I mean, the biggest risk for Uber is the robotaxi rollout. The fact that Tesla hasn't included them in the plans. They are partnering with whoever they can in terms of getting the vehicles. Now, BYD is more EVs. I don't think their software is as good, to kind of propel them in the robotaxi arena. But clearly, they are doing very well in terms of the install base of EVs outside the U.S. And that's why I think they are early to partner.
Yeah, and you can see Uber shares rising today. Mandeep Singh, you're going to have a very busy day, very busy week. We appreciate you taking the time with us now. That is Bloomberg intelligence analyst Mandeep Singh. Now, coming up on Open Interest tomorrow, we have Megan Horniman of Verdance Capital Advisors, Tom Forte of the Maxim Group, and Anastasia Amoroso of iCapital. Of course, we're going to be unpacking what we learned from the Fed today and also what we hear from Meta and Qualcomm after the bell tonight as well. This is Bloomberg.
Everything. From the heart of where innovation, money, and power collide in Silicon Valley and beyond, this is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
Live from New York, this is Bloomberg Technology. Coming up, we sit down with the CEOs of AMD, T-Mobile and Pinterest as tech earnings hit full send. Wow, plus Microsoft Azure growth tests investors' patience as AI spend ramps, and the US sparing ASML and Tokyo Electron from chip curves. We bring you the details. What a morning I woke up to this morning. This is what the earnings that have gone before last night look like in terms of the share reaction. Many different stories, a lot of it centered around AI. Microsoft down 1.3%. Off session lows, the story, slower than expected Azure growth, an 8% contribution from artificial intelligence. But investors look at the CapEx and go, we don't see the growth or the money coming out the other side of that equation. AMD, a different story. They actually boosted modestly the guidance for the outlook for the MI300 AI accelerator family sales for this year. And as you guys know, we're going to be speaking to Lisa Su really soon. So many important questions. Lastly, Intel up more than 1%. Bloomberg is reporting, citing sources, that they are going to cut thousands of jobs to respond to the lagging earnings and get focused back on getting that foundry or fab business off the ground. Here's another one that I'm really interested in. T-Mobile really coming in strong. The stock has kind of bounced around this morning on T-Mobile, but is now up around 3 to 4%. And the story's so interesting. It's those monthly subscribers that are coming in well. I looked at the industry, and I think the industry as a whole has done really well on that front. Delighted to bring in the president and CEO of T-Mobile, Mike Sievert, who joins me on set in New York City. Good morning.
It's great to be here. Thanks for having me.
Really interesting, that number, the subscriber number, because I look at your peers and competition who also seem to be doing well. So it raises the question, where are your gains coming from? From them? Or is there just like this new generation of customer that's appeared?
Well, we're seeing nice organic growth in the industry. So everybody did pretty well. Both of my principal competitors, I think, had net gains that were a little better than expected. But T-Mobile took the prize. I mean, this was the biggest Q2 for postpaid net phone additions ever in our history, and we took more than
the prize from who, Mike? That's what I'm trying to...
Well, we took more than AT&T and Verizon combined. So this is still a share-taking story for us. And, you know, of course the industry's growing. That's healthy, that's positive. But T-Mobile's the disproportionate winner in the growth game. Our postpaid service revenues up 7% year over year, more than twice the pace of the principal competitors.
Mike, back in California, we're a T-Mobile household, and I use Verizon for my kind of work business line. But it's the technology story that I'm most interested in. You know, I think back to when the iPhone 15 Pro generation came out. I went there because of incentive, a credit back on a new handset, the incentive of having multiple lines on one account. And I always want to know how much of a factor that still is for you guys to kind of think, well, what can we do on the incentive side to either renew existing customers or bring in new ones?
Well, customers have always trusted T-Mobile to be the best value in the industry. That's our legacy. That's our heritage. And what's interesting is now that we're the best network in the industry also, some would expect us to give up that value position, but we're not gonna. You know, we have the best promotions, we have the best overall value, we give you more, we ask less of you, and we have the balance sheet and the cost structure to defend that value position for the long haul.
It's great to have you on Bloomberg Technology here in New York, and one of the technology stories with T-Mobile's fiber, KKR, Lumos. I think you've talked about the importance of that and the ramp, but I wondered if you just give me some specifics, why, and also how you grow your investment and why you did it.
Last week we announced our second transaction in the space. The first one was Lumos a couple months ago. Last week we announced that we are collaborating with KKR to purchase Metronet. And Metronet is the fastest growing pure play fiber company in America, and arguably the most important. And so it's really terrific to be collaborating with KKR. Our joint business plan for this asset and this team is to grow it past 6.5 million homes passed within the planning period now till 2030, and to do so without further capital calls.
Is the long-term opportunity for you bundling? So you look at your subscriber customers, you look at what the household does with you want them to do more? Is that the idea?
Well, it's the current opportunity. Remember, T-Mobile's a major broadband provider today. In fact, we have 5.6 million broadband customers through our fixed wireless product. This quarter, Q2, T-Mobile took our highest percentage share of broadband net adds ever in our history, 75%. When you add up all fiber, all cable, and all fixed wireless, one brand, T-Mobile, took 75% with over 400,000 net additions. And so our value proposition is resonating with people, and part of it is, sure, they trust our brand and they want to buy wireless from us and broadband from us.
Stock's now up 4% in the session, up about 14% year to date. This is Bloomberg Technology. One of the companies that I cover is SpaceX. I'm really interested in the Starlink relationship, but when I flew here on a United Airlines flight, I was able to access Wi-Fi in flight because I'm a T-Mobile customer. You've got different options there. What's the big picture strategy?
Well, first of all, I'm glad you acknowledged that benefit. This is so exciting. We have partnerships with most of the...
Because United doesn't have Starlink, is my point at this moment.
Correct, and we have partnerships with most of the major U.S. airlines such that T-Mobile customers get free Wi-Fi on flights, and it's so great, and we're doing that through satellite connectivity with a number of partners. But what you're asking about is our exclusive arrangement with SpaceX. We have a technology alliance, and we intend to be the first ones to bring satellite connectivity to your day-to-day usage of your mobile phone. And the vision here that's joint between us is to eliminate dead zones. The idea that if you can see the sky, you're connected, and you can message, text, and eventually make phone calls and have some data to be connected to the people and the issues that you care about.
An interesting technology conversation, and you acknowledge the competition and growth across your industry as well. Mike Sievert, T-Mobile CEO, and of course, president of T-Mobile as well. Now, I told you this was a day where you need to buckle up. We have a lot of earnings coming thick and fast. AMD shares currently up 6%. At one point in the session, we're up 11%, putting them on track for their biggest jump since February. That following positive earnings results, showcasing a boost in sales from the company's AI accelerator, the family of MI300, but also some interesting recovery in the PC business. Joining us now is AMD CEO Lisa Su. Good morning to you, Lisa. You know, I think that's where everyone was looking, right? MI300, and whether or not you could go beyond the $4 billion. And you said $4.5 billion. I wondered if we could start by discussing the factors behind that. What changed, whether it was supply or demand in shipping more of the MI300 family?
Well, good morning, Ed. It's great to be here with you today. Look, we had a very strong second quarter. We're very pleased with the overall growth that we saw, really led by the data center business. So our data center business more than doubled year on year in the second quarter, and we see, you know, a strong second half there as well as strength in PCs. So, you know, to your question about, you know, MI300 and what are we seeing in AI, you know, we're seeing an environment where everybody needs more data center AI infrastructure. You know, computing is really the foundation of what drives, you know, sort of all of these AI capabilities going forward. You know, MI300 has been well into the qualifications at numerous of our top customers. And, you know, what we saw over the past quarter is we passed some very significant milestones in both, one, you know, ramping up our supply chain, but also passing important, you know, data center customer milestones where customers have moved our product into production. So it's an exciting time right now. You know, we did update our full year AI guidance from greater than $4 billion a quarter ago to greater than $4.5 billion. I think we're seeing great traction in our hardware and you know, software milestones. So overall, I'm feeling really good about the setup going into the second half of the year.
Lisa, I'm really interested in kind of the design and performance differences for all the AI accelerators that are out there. You and I have talked about the technology differences, but on the call, you gave the example of Microsoft and its use in the quarter of the MI300 generation. When you're speaking to a hyperscaler, when might they opt for using MI300 over NVIDIA's H100 and I suppose to a lesser extent Gaudi? What is the specification or performance driver that would make it a better solution in a certain use case?
Yeah, well, first of all, you know, I'd like to, you know, say that Microsoft is a phenomenal partner. They're a great partner for us, you know, across, you know, the data center as well as, you know, the client businesses. And when you see, in particular, you know, how complex these AI systems are, you know, you want to have, you know, the best technology capability. You know, I can go into speeds and feeds, but I won't. I think it's suffice it to say, you need this type of computing for both training and inference. In our case, MI300 is the leading inference accelerator today. We have the highest memory bandwidth, and that's really helpful. When you're asking questions to, something like, a ChatGPT or Llama model, and you want your answers to return faster, you want the fastest inference accelerator out there. And, MI300 does very, very well in that framework. And then when you take a step back and just look at the overall AI market, the overall AI market is growing so fast. There is no one solution fits all. Actually, you do have, different workloads will be optimized with different hardware. So I think we have a tremendous opportunity. I think we're very excited about the overall market growth. And then as more customers get a chance to use our AMD Instinct roadmap, I think we're getting very positive feedback.
Lisa, you addressed head on the call, I think, that the investment cycle for AI has legs. It will continue. But just interested in what you just said, can you kind of apportion of how much of that spend or investment is going to training versus inference at this stage?
Yeah, absolutely. So when we look at this cycle, Ed, you and I have talked about this before. We're forecasting that the overall market for AI accelerators, when you look out and let's call it 27, 28 and beyond timeframe, will be $400 billion plus, which is huge market overall. I think in that you're going to need a lot